Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello, everyone. Welcome to the Through the Noise podcast. In the first month of 2026, we see markets navigating shifting geopolitical dynamics, strong tech earnings, and also FX realignments. So today, I'm joined by Fook Hien, our senior investment strategist, and we'll unpack the key drivers behind these moves and what they mean for investor positioning. Hi, Fook Hien. So we see that there's a surge in gold prices that seems to indicate a change in the world order. So would you please share some thoughts on what the new orders would look like and what do you think is the best way to position an investment portfolio now?
Yeah, hi, Michelle. So this year's surge in gold and silver prices, it reflects escalating geopolitical uncertainty and the emergence of a new world order. President Trump's indifference to the US dollar's decline to a four-year low, coupled with heightened fears over US intervention in Iran, have intensified gold's rally. So although prices appear stretched in the short term, it reinforces gold's enduring value as a hedge against elevated risk. Despite the persistent geopolitical challenges, we continue to favor a pro-risk stance. We continue to be overweight global equities, supported by strong corporate earnings, especially in the transformative AI-driven technology sector. However, the ongoing weakness in the US dollar, it makes a global diversification more compelling. And historically, non-US assets, particularly emerging market equities and bonds, as well as alternative investments, they have excelled during periods of dollar weakness, and they remain critical diversifiers alongside gold. This year, we've seen gold surge 25% and silver by over 60%, outperforming equities and other major asset classes for a third consecutive year. Haven currencies, such as your Swiss franc, have also outperformed, along with the Australian dollar, which represents a major gold exporter. The recent US actions in Venezuela and disputes with the NATO allies over Greenland, they highlight a reconfiguration of the post-World War II global order. This was reflected in Canadian Prime Minister Mark Carney's speech at Davos last week and in the new global alliances. The European Union, they announced this week a free trade agreement with India after 2 decades of stop-start negotiations. The announcement, it drew sharp criticism from the US, which has imposed a punitive tariff against India for buying Russian oil. So for gold today, we are cautious short-term, but we see long-term opportunity. The technical indicators and investor positioning, it suggests the rally in gold and silver may be overextended, leading to a near-term pullback. Now, this would present opportunities for long-term investors. So those underweight in gold, they could consider increasing exposure during pullbacks. Our balanced portfolio, it holds 6% in gold. Conversely, investors who are overweight in gold, they should rebalance into alternative assets to reduce portfolio volatility. Gold remains preferable to silver as the gold to silver ratio approaches its lowest point since 2011. The silver surge, they could also curtail industrial demand and lead to increased substitution by other metals.
Got it. So let's look at the US equities in a bit more details then. What are your thoughts on the US tech earnings releases?
Yeah, our view is that the US technology sector is buoyed by semiconductor and internet companies. It's posting the highest earnings growth across all US equity sectors. And the 2026 estimates remain strong. The tech earnings we have seen, it remained resilient in the fourth quarter of 2025. It's posted the highest earnings growth across all sectors at 28.2%, and this is significantly above the broader index growth of 10.2%. And these are numbers sourced from LSEG IBIS. So we see these semiconductor and internet companies, they have been reporting solid results and demonstrating strong price momentum. And in the semiconductors, this is largely attributable to your surging memory prices and pent-up demand for semiconductor capital equipment. Meanwhile, on the software and IT services, which typically benefit later in the business cycle, they remain relative laggards due to capex concerns and also near-term AI disruption risk. Despite the headwinds in some subsectors, we project a full year 2026 EPS growth at a 31.1%, which has been revised up since the start of 2026. And this is based on accelerating earnings revisions and solid financial stability. The 12-month forward price earnings ratio for the technology sector is at 26.2 times, which is slightly below its 5-year historical average.
Got it. So apart from US equities, let's turn into India equities also. So what are the primary drivers behind the continued underperformance of Indian equities year to date?
Yeah, we see here four key drivers which underpin Indian equities year-to-date underperformance. There's continued pressure on the INR, which has made foreign investors cautious. And also we see a heightened market volatility ahead of the union budget for 2026 to 2027 on the 1st of February. And thirdly, as well, there's been a lack of investment opportunities in AI within India. And this is pushing investors to countries with higher technology exposure. And then lastly is a lack of a positive development in the proposed India-US trade deal. So while we see emerging market and Asia ex-Japan indices, they're up by around 11 or 10% year to date respectively. India remains down by around 3%. And despite its valuation premium to the emerging market and Asia ex-Japan indices coming down to about a 35 to 50% premium. And this is significantly lower than the 2024 highs of 85 to 91% premium. On an absolute basis, India's valuation of the price earnings ratio is at a 6% premium over its 10-year average, which is now more attractive relative to the emerging market and Asia ex-Japan. We continue to be positive on India as a reflating economy is likely to drive a revival in earnings in the coming quarters. So the early Q3 2025 results, that's for India's Q3 fiscal year, the results indicate a double-digit revenue growth for Nifty, which is encouraging. Furthermore, India remains a good hedge against AI-related pullbacks, and any positive development in the India-US trade deal is likely to improve sentiment.
Got it. So we've just mentioned about global equities, and we also have another commonly asked questions about FX. Overall, we've seen a weak US dollar as we've discussed earlier, and the other side of this is actually the strength in the euro. So how sustainable is the euro rally after the euro dollar reaching a 4-year high, and given the recent sell-off in the US dollar?
Yeah, our view is that the euro to dollar, its latest surge appears driven more by positioning rather than fundamentals. The pair is now overbought and is likely to trade around 1.18 to 1.21. The euro dollar, it appears poised for a short-term technical pullback towards 1.18 before potentially resuming its upward movement. While it remains range-bound at elevated levels, volatility is set to persist. The euro's sustained strength is attracting increasing scrutiny from the European Central Bank, the ECB, especially as the currency approaches the upper end of the central bank's comfort zone near 1.2. This is well above the 1.16 level factored into its inflation assumptions. So we see the US dollar's swift decline driven by policy uncertainty and concerns over fiscal management. It has encouraged investors to seek alternatives in European currencies. The ECB officials, they have indicated that if the euro strength continues, a policy response may be required, not because of the exchange rate per se, but due to its potential implications for inflation. So unless a fresh catalyst emerge, this rally does seem excessive to us, and the euro dollar is likely to consolidate.
Got it. Thank you very much, Fook Hien, for your sharing. Overall, a few key takeaways for today. First of all, we're bullish on gold prices on a longer term, although a near-term pullback looks likely. Second, we expect solid earnings in the US tech sector to support further increase in share prices. And overall, we also prefer India within Asia ex Japan on reflationary environment and a strong revenue growth. And last but not least, euro dollar is likely to consolidate near term before resuming its uptrend movements. If you'd like to stay updated with the latest investment trends, please don't forget to like and subscribe. And we'll be back next week with more market perspectives.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.